Next up in the investment plan, we have a risk tolerance section. By now, I'm sure you know that investments don't come without risks. But this section isn't about analyzing the level of risks of each investment, but rather identifying the tolerance you have for risks itself. So finding out your tolerance for risks is a crucial part of your investment plan, since this awareness is what's going to help you strategize a majority of how you invest. In general, depending on how much risk one can tolerate, investors are categorized into three: the aggressive investor, the moderate investor, and of course the conservative investor. Now, aggressive investors are those with a very high risk tolerance. They'll be willing to lose any amount of money for the chance to have greater results. Moderate investors are those with, well, moderate risk tolerance. They aim to grow their money without losing too much of it. And conservative investors, on the other hand, are those with little to no tolerance for risks. They prefer to have a stable investment portfolio with very low and preferably no volatility at all. Now, as a beginner, it might be quite difficult for you to place yourself among these three types of investors, but maybe it can help to factor your age into this. When it comes to taking risks in investment, there's a popular notion that when you're younger, your ability to take risks is much higher than when you're older. In other words, it essentially means that you can invest your money in high risk investments when you're young compared to when you're old. So for example, let's take stocks. Stock investing is a very popular high risk investment with rewarding returns. And if you want to have stocks as a part of your investment portfolio, you need to determine what percentage of your portfolio is going to be dedicated particularly to stocks. Now, this is how the age concept supposedly helps answer you the previous question. According to an old rule of thumb, what you do is you take the number 100 and deduct your age from that. The result is the percentage you should allocate for high risk investments like stocks. For example, if you're 40 years old, 100 minus 40 is 60. 60 is the percentage of your investment portfolio you should keep in stocks. If you're 50, you should keep 50% of your portfolio in stocks and the rest in securities. This is an old rule that has changed now over time and has helped evolve to deduct one's age from 110 or 120 instead of 100 to determine how much percentage of your portfolio you should allocate to high risk investments. The logic behind this method is merely a way of making your money last for much, much longer. In other words, if you want to make your money last longer than that, you'll need extra growth that stocks can provide. Based on all these common notions and rules of thumb, we have developed an investment portfolio that is suitable for each age group. The logic behind this whole concept of age and risks is when you're young, even if you lose money due to high risk investments, you still have the time to recover that. But as you get older, you might not be able to afford to lose money, since you might need it for something very important, or you might just need to have that money, or you might not have the time to earn that money again. So that being said, this is definitely not a rock solid rule that everyone should just abide by. It is more of an interesting concept that anyone can make use of regardless of how old you are. Just try to place yourself in a group depending on the portfolio mix you would like to pursue. It can either be a growth-oriented portfolio that has been suggested for those between the ages of 20 to 30, or an equal weighted portfolio given for those ages from 40 to 50, or even a conservative portfolio that has been given under the 60s. Whatever it may be, once you place yourself in a certain group, proceed to customize these percentages to create a portfolio that will align with your investment style, your investment goals, and of course the time horizon.